We've just entered July, which means today we're back with a Vanguard portfolio update. For those of you new to the channel, this Vanguard account that I'm going to show you today is no longer active. It's a previous year's ISA, meaning I no longer am able to put new money into it. Instead, I just leave it alone and reinvest the dividends that come from it. And hopefully over many decades, this will grow into a nice little pot of money that I can add to my retirement amount. I currently invest on a platform called Trading 212. I'll leave a link in the description. If you use that link, you'll get a free share when you sign up worth up to £100, and you've only got to put £1 in. But I use that platform because that allows me to invest in individual stocks, whereas Vanguard doesn't. Let's start with a recap of what's happened since the last update to set the scene for what's going on in my portfolio. Well, I can say I've definitely noticed things getting more expensive, and I'm sure you have as well. My weekly food shop honestly feels like I need to take out a small loan for it by this point, and the items that I go to the shop and get every single week just seem to be getting more expensive each time I go. The Bank of England's 50 basis point hike in interest rates now mean that we're at the highest level than we've been since 2008. So there is a reason that you're feeling like things are really expensive right now. And we are definitely not at that 2% target that the Bank of England have for our inflation. Let's just have a look at this Trueflation website. I've done it time and time again on these updates, but definitely check that out. It's basically an independent website that looks at the true level of inflation using many different sources. Okay, so we're currently on the US inflation. So you can see that the US true inflation using their data comes in at 2.2%, whereas the US government are reporting 4%. So they're actually saying it's slightly lower than what the government are reporting over there. But let's just switch to the UK. And we'll look at that. So our true inflation right now is meant to be 11.11%, whereas we are being told it's 8.7. That's absolutely crazy. Increasing interest rates is one method, one tool in the arsenal that the government have to try and calm inflation down. It's like a seesaw where you have inflation on one side and interest rate on the other. When one goes up, the other typically goes down, and vice versa. But of course, raising interest rates does have quite a big knock-on effect to all different types of things. One thing is that people get better rate in savings accounts, and that means that people are a little bit deterred away from spending their money, but also from investing their money. You've probably seen adverts and even your own bank offering better rates now, and that is because the interest rates have gone up. But you've got to ask yourself, are you getting the interest rates in your saving accounts that actually match or beat inflation? And the answer is probably not. Now, it's still worth switching to a better saving account that will give you higher interest rate that works for you, because you might as well get the highest you can get. But I still don't think this should be what deters you away from investing, because if you just look at investing and saving, you're most likely able to match, if not beat inflation, with investing into something like the S&P 500 or whatever it may be, as opposed to just saving your money. Also, not saying that you shouldn't save any money. You definitely should have an emergency fund at the very least. Another thing that's impacted here are mortgages, specifically new mortgages or remortgaging. People that haven't got a fixed rate deal on their mortgage already are probably in some bother right now with the raising interest rates. Also, even people with these fixed rate deals, 2.4 million of them are actually due to expire by the end of 2024. And the average 2-year deals are now above 6%. So many people are actually going to see their interest rate triple over the upcoming months. Just going back quickly to what I was saying about food prices being really high here at the moment. It's because the UK are specifically vulnerable to food prices and also energy prices. This is partially due to harsh weather affecting crops, being reliant on imported gas, and also labour shortages. Different sectors are affected differently by a high inflationary environment as it gets more expensive for businesses to borrow money. Sometimes we see higher profits for the energy sector and the commodity sector, which I'm sure you have seen the reports about Shell making the most money and all of these sort of things. But that's because they can pass their rising costs very easily down to the consumer. But there's lower profits for businesses in the consumer discretionary sector and the tech sector, because these are choices. People don't have to buy their goods. Therefore, they just won't if times are really tough. Those are the sectors that are particularly sensitive to changes in consumer spending. So it's all been a little bit doom and gloom here in the UK over the last 1 month. We've not really seen an awful lot from the FTSE 100 index. It's down by 1%, which continues the declining trajectory of this year so far. Over in the US, their inflationary problems aren't quite as bad as they are here. We saw on Trueflation that it's reporting a 2.23% inflation rate right now. A couple of weeks ago, we heard that the US Fed were making the decision to pause interest rate hikes after 10 consecutive increases. And instead, they were going to sit back and monitor inflation to see if it starts coming down after those 10 consecutive increases. So we'll see what happens on that one. So in the US in the last month, we've had inflation starting to ease, but the economy slowing down, the US stock market being very volatile, and the housing market cooling a little bit. A lot going on. So how has the S&P 500 reacted? Well, to understand that, you first have to understand what companies are actually making up the majority of the S&P 500. Which companies have the control to move the S&P 500 index. I've made a video all about that, so when you're finished watching this, definitely recommend watching that one. I'll link it on the screen somewhere up here now. The S&P 500 has actually had a pretty decent month compared to the FTSE 100. And that's because the companies in the S&P 500 by largest weighting are all doing very well right now. Partly due to the AI boom and also partly due to inflation easing. This year in general, actually, the S&P 500 has done pretty well. This is causing a nice increase in my trading 2-on-2 portfolio, where I actually hold some of those top tech companies that are doing particularly well right now. But also ETFs that have a high weighting for tech stocks are also doing very well. Even the S&P 500's top 5 to 10 holdings are seeing particularly big increases. So that's pushing the S&P 500 trackers up too. And the reason probably why the UK market is not really following this trend and seeing big increases with this AI boom is because we don't really have that many big tech companies here in the UK. So now we've set the scene, let's look at what's been happening in my Vanguard portfolio. So first thing is my total ISA value, currently sitting at £6,553.84, which is a lot higher than last time. Last month, it came in at £6,299, which seems like a big increase for an account that is not active and I'm actually not investing any new money into. You'll also see that VUSA is still my largest holding, sitting at £4,589.71 and making up just over 70% of my ISA. Now, last time, VUSA made up 68.91% of my ISA, so there's been a little bit of an increase there. And you have to remember that the weighting of a position can go up when you add new money to it, when you reinvest dividends, but I've not done either of those things to this and it's still gone up. And that's just because, again, when a position does very well, it increases its weighting in your portfolio. If an investment's price increases, its weighting in your portfolio will also increase, even though the total number of shares that you own does not go up. This is because the value of the investment does go up. The personal rate of return since the account opened is looking very lovely right now, 13.93%. Last month, it came in at 6.53%. So this is nearly double what it was last time. And this is due to just good performance and also reinvesting dividends that I covered in the last video. So let's head over to the investment tab now and actually see what makes up this portfolio. For those guys who watch every single month, surprise, surprise, this is no different because I don't change this portfolio. We've got the FTSE Global All Cap, which is an index fund, and we've got the S&P 500 ETF VUSA. But this tab is looking very different compared to last time. In the last month's update, we had the FTSE Global All Cap being about £20 down, whereas now it's £50 up. And VUSA last time was sitting at about £80 up, whereas now 264.86. So in total, if I were to withdraw this portfolio right now, which I'm not going to do, I would have made £314, which is not that much considering how long I've been investing. And if I were to withdraw my entire trading 2-on-2 portfolio right now, which has individual stocks, which has been going on only since April, I would be up by about £3,000. So it's quite different, but the whole idea of investing into things like this, index funds and ETFs, are that they're passive, they're easy, they're more guaranteed in terms of returns than individual stocks, so you can sleep better at night. And you've got to leave them over long periods of time because compounding really has to take effect. And with something like this, it's not going to happen in just 2 years, because 2 years we might be experiencing a really bad downturn in the market, which we kind of have been, right? If these 2 years were as they were going up, this number would be quite nice and maybe I'd be able to make a little bit on it. But that's not my intention. I'm looking to leave this for many, many years. Let's now go on to this performance tab. I stopped investing in April 2022, just before I began putting money into my new ISA, because you can't pay into 2 stocks and shares ISA in one given tax year. So since this point here that I'm hovering over, I have not actively put any new money into this account. So the performance from this point onwards is purely down to the market and not any additional money. And what you can see over this time period is that there are a lot of short-term volatility, peaks and troughs, ups and downs. But over the long term, over this period, it has gone up slowly. It's higher here than it was back here, but it's very, very slow. And this is because with investments like this, you need to leave them alone and you need to let compounding work for you. If we click on the month tab here, we can see the performance broken down each and every month that I've had this portfolio open for. And just at a glance here, we can see that June was very nice to us in this portfolio. We can see lots of green and market gain was £218. If you scroll, you will see some months where there are a lot of red, but all in all, I think the green outweighs the red. Now let's head over to the transaction tab here. And this is the same as last time. I have not put any new money into it and I've not reinvested any dividends. On the 1st of June, you can see that I purchased some more S&P 500 ETF VUSA, and that is because this was reinvesting those dividends. You can do that, you just can't add new money in. So my plan with this account is that I'm just gonna let my dividends keep coming in. They're gonna tot up on my cash, and then when I've got enough to pay for 1 share of VUSA, plus some left over for fees, I'm going to reinvest the dividends. That's my plan. In the cash statement, you can see that happening right here, where I've purchased 1 share of VUSA, and I've still got £24.02 left. But look, I got some interest. 6p has come in since the last update. Woohoo! Well on our way to retirement over here. I do have VUSA in my account, and VUSA does pay a dividend. Let's just take a look at it on Vanguard's website. They pay 4 times every single year, so they're a quarterly dividend payer, and they pay in June, March, December, and September. Of course, we have now entered July, so I should have got my VUSA dividend payment in June, the end of June. I have not received it yet. Vanguard typically are a bit slow with their dividends, so I do expect that to come in any day now, maybe even up to mid-July, we'll see. Hopefully on the next update, I'll be able to tell you that I received a nice amount of dividends, but I'm not too concerned. It doesn't really matter to me. It will just get reinvested when it does come through. Let me know how your portfolio is doing in the comments below. Thank you for watching this video and clicking on this video, and if you haven't already, please consider subscribing to the channel. It's absolutely free and you can change your mind at any point. Kind of like the best subscription service out there, right? I'll see you guys in another video very soon.